Welcome to the Asset Revolution podcast, where each week your hosts from Arbor Digital provide educational opportunities for financial advisors and individual investors to gain knowledge in this emerging powerhouse that is digital asset investing. The Asset Revolution podcast is your connection to the future of digital assets and an opportunity for anyone to get off zero. Let's dive in. All right, everybody, welcome back to the latest edition of the Asset Revolution podcast. Today, it is all about Q3, quarter three, 2022 recap and a bit of an update on the markets, both traditional and digital. And today, I am very excited for that traditional side because we have a guest from a very important piece to the Arbor puzzle, which is Arbor from Arbor Capital, Matt Schechter, who serves as CIO and financial advisor on the team based in Anchorage, Alaska. And Schechter, is that where you are right now?
I am in Anchorage, correct. I am not in Chicago. So.
Wow. Okay. So if you are watching this, you're going to get to see a little bit of a skyline. And if you're listening to this, go hop over to our YouTube channel and make sure you go check it out. But Schechter, welcome to the show.
Thank you. It's great. It's great to be on. Thanks for having me.
Oh, you're welcome. And so Matt, real quick, just give everyone a quick introduction of yourself, a little bit about your background and what you do for Arbor Capital.
Sure. So in terms of my background, I'm actually originally an accountant by training. So I was an accounting undergrad, went to Michigan, got my CPA kind of right out of school, but didn't go into audit. I was actually on the corporate side for a lot of years. So and I evolved from kind of on the accounting and tax side in corporate and to ultimately becoming a forensic accountant on the investing side. I started that about 18 years ago. So over the course of the discussion, if I start to deviate into a few accounting terms or languages, that might be why. So, went finance, got my MEA at the University of Chicago at night in the 90s. I worked for a forensic accounting research firm from 2004 to 2012 called CFRA. And they're still around to this day. And I was a forensic accountant there, basically looking for companies using accounting issues to mask problems in their business. Left CFRA in 2012 to join Balyasny Asset Management, which is a big multi-platform hedge fund, and helped run a forensic accounting group there. And then in 2019 left there and then came on board here about almost a little over 3 years ago to join Arbor, both in an advisory role and as well as help with investment research and decision making.
Wow. So for those of you who haven't really done any due diligence on Arbor Capital, don't know where we come from, I hope you now understand a little bit more of the perspectives that we have here as a broader team. But Matt, I'd love for you to share as well. Have you always been based in Alaska?
No. So grew up in New York, migrated west to go to school at Michigan, then eventually landed my job in Chicago. My wife and son are still back there in Chicago. My son's finishing up the senior year of high school. But migrated to Alaska about 14 years ago when we got a place in a town called Girdwood, which is just 30 miles outside of Anchorage. So we've been slowly establishing deep roots here.
Oh, that's so wonderful to hear. And it's wonderful to have you on the show with us. We hope this isn't your first and only appearance, in fact, but I'm really excited to dive in. And before we continue this along, very quickly, I know if you're listening to this, both Matt and I, but just in case this is your first time here, Matt Kolesky is also joining us from Houston, Texas. Matt, real quick, introduce yourself.
Hey, everybody. Yeah, thanks, Mark. It's great to be back here with you. My name is Matt Kolesky. If you haven't watched or seen me before, I am president of Arbor Capital. And as Mark said, I'm in Houston, Texas. And Mark and I are, along with some of the other folks here, are running Arbor Digital. And I'm excited to have Matt Schechter here to bring us some traditional perspective to the Asset Revolution podcast.
Here. And just real quickly, for those who don't know me, I am the host, Marc Nichols, joined Arbor Digital in 2021 where I have been closely partnering with Matt and the team that we've built to bring forward our services to other advisors across the country. So that's the lens at which I come from. And today, the purpose of this show is we're going to just dive into a Q3 market update, both on the traditional and the digital asset side. So let's kick this off. That's what everyone's here for. So I'd like to start off with you, Matt Schechter. Just give us a quick rundown from your perspective. What did Q3 look like in the traditional world?
So it was an interesting quarter. So, kind of looking back at it, to say the least. I think the markets kind of moved more on the comments of the Federal Reserve, as well as macroeconomic data, things like inflation rates, CPI, unemployment rates. Earnings in the quarter were okay. Some companies are starting to guide down, but it seemed like, boy, for this past quarter, what the Fed said really mattered much more to what the equity markets were doing than what companies were saying. I think when Chairman Powell spoke in late July, I think it was, he had a speech, and I think he came across as being dovish by the street. I didn't necessarily interpret that way, but I think a lot of people did, and I think that's what started the market rally. And then the Fed had to and then between the inflation data that came out, the CPI data that came out, that was higher than what people were expecting, coupled with Powell's comments about basically hiking until they break inflation. I think that's what turned the markets, kind of basically for September.
Yeah. I think one thing when we were in digital asset land, it's been so closely tied to the macro narratives, digital assets so far this year. When those comments, we saw a similar rally in digital assets, but then once it flipped a little bit, but it didn't quite go down as much, didn't reverse as much. So we saw a little decoupling, but it's still interesting to see how closely tied to what is being said by the Fed. And I think what we're all feeling here is that it was a recommitment that they are going to fight inflation through rising interest rates no matter what. So I think a lot of people are a little more hopeful in digital asset land that they would pivot a little sooner. And I think those are dashed in Q3. So that's interesting to see. But what else was important going in from on the traditional side? You mentioned equities and earnings. What else caught your eye?
So there's things that I'm looking for in earnings, and so we had Q2 earnings effectively in kind of the Q3 calendar. We had Q2 earnings being reported, right? So what I'm looking for at that juncture are a couple of things. So when it comes to things like inflation, right? There's the CPI data, which is kind of historical looking. Right. I'm also looking at the PPI data, right? Because that's the producer price index. And I kind of view the producer price index as almost being a leading indicator for the consumer price index, because if industrial companies' costs go up 9%, chances are they're going to try to pass that on to the consumer, right? Either that or, and if they do that, perhaps they're going to lose volume. Or the other option is that they're going to effectively absorb those costs and their margins will decline, right? So the PPI is somewhat important in that regard as a leading indicator. But the other thing in Q2 I was listening for was commentary by management teams. So at Arbor, we own individual equities. So amongst those, I want to hear what the companies are saying about their perception of where costs are going, right? And that could be a consumer staples company. It could be a company like Coca Pepsi. It could be a retail company. What are they seeing in terms of commodity costs, wage costs, and such in their business, and how is it impacting their guidance? And so the interesting thing that kind of came across from companies in Q2 earnings is that from an inflation perspective, Q3 and H2 of 2022 were not getting any better, right? In terms of commodity costs, the situation was not expected to improve, right? So when you kind of have companies that are buying commodities at scale, saying that the situation is not going to improve, that doesn't lead me to necessarily a bullish tint when it comes to what I think inflation might do. And so I think that was one of the key takeaways from a commodity cost side. The other thing that I like to listen to closely are the banks. And so they generally report early. And so the main thing that you're looking for are things like early delinquency rates and what's going on with loan loss provisioning. So from an accounting perspective, I kind of mentioned I have an accounting background. So the accounting rules essentially have changed in the last couple of years where companies use what they call CECL, and they're required to reserve upfront for loan losses that they think are going to incur within, the next, couple of years, right?
Mm-hmm.
And so prior to the quarter, JP Morgan actually increased their reserves substantially in advance of what they thought would be an accident that might happen, I think, in the economy. And banks are slowly starting to increase their reserve levels. They're not seeing the delinquencies rise and kind of the charge-offs rise as they have to write off problem loans, but they kind of see the storm clouds on the horizon. And so I like to listen to those. And it's not just the prime banks. As a matter of fact, this morning, actually, on my way driving to work this morning, I was listening to an earnings call from Ally Bank, which is not necessarily a prime bank, but also has an element of subprime. And I'm looking for where cracks are starting to appear for loan losses and for lending and such like that. And, so to see if there's, issues in terms of things like mortgages, autos, right? Things that are central to the economy that are effectively slowing down or stalling. So from an earnings perspective, that's what I've been listening to.
Very interesting. So you're looking at these companies, you're looking at the management, how they're forecasting, what does their guidance look like, and in terms of their balance sheets, their costs. You're
Right.
looking at the banks, this loan provision loss and these other areas.
Right.
So what are you seeing what else did you see, I guess, across traditional markets? How did that reflect in price action?
In terms of price action, in terms of most companies, I think it was the Fed and honestly the kind of the wave of activity that really kind of overwhelmed earnings unto themselves. I don't want to say any one of the company's particular earnings were a significant event.
Mm-hmm.
I think the one earnings that jumped out at me was Microsoft effectively guided down in the quarter, which when you start having some of the mega caps start to bring down earnings, I find that to be interesting.
Mm-hmm.
But we kind of haven't seen that wholesale quite yet. And it's something that I'm on the watch for. But it's kind of like, well, when does the deterioration really start with the consumer and with the industrial space? I think one of the other things I'll point out from a traditional markets. So a lot of the companies we own, when I've seen revenue growth this quarter, or even the last couple of quarters, first two quarters, when they had revenue growth, it wasn't for many companies volume. It was almost all price. So when you think about revenue growth, you can break it up into kind of three components. One is higher pricing, two is higher volume, and three is a change in price mix or a mix, like whether it be product mix or channel mix or something that effectively helps drive revenue growth. And whether it was an industrial company like Dow or a consumer company like McDonald's, right? It seemed to be all price. It was not volume.
Yeah.
So,
and Matt, if I can jump in, you said you and I have talked over the years, and you said something just now that makes me think about I view. Let's look at the U.S. market as a empty swimming pool, right? And the companies are, I don't know, like things that are floating on there. And the currency is the water. So here comes the Fed dumping all this currency in, and it's just flushing. And this has been going on for 10 years, right? And so it's not necessarily, these companies, and they are, right? They're producing more value, but sometimes it's just there's more dollars, so they're going to show up on the top line, which is what you're talking about. It's not necessarily additional units of things sold or additional units of square footage. It's just purely numbers going up because there's more dollars floating around.
Mm-hmm.
And that's what you're seeing. And now the Fed's starting to slow that down. After 10 years of saying, inflation isn't coming and it's transitory. Well, guess what? Now it's here. And now, Matt, you're seeing it manifest itself in these ways. And I think it's important to hone in on that, what you just said there, because it's just the prices are going up, which is the idea of inflation. But it's also at this fundamental level, it's a unit of account, right?
Mm-hmm.
And so sometimes it's just more dollars at the top line is all it comes down to.
Right. And so, and one of the things that actually to circle back on the comment with the Fed, right? So as the Federal Reserve has been raising interest rates, right? and the rate of increase has been, almost hyperbolic, right? I mean, 75 basis points a month over the last few months, right? It's going to probably continue through the end of the year, right? You're starting to see significant, declines in mortgage origination revenue at the banks, right? They're with the banks we own, they're seeing, auto loan financing, those types of big ticket items. The volume of business is deteriorating substantially.
It's almost like they're going to try to control inflation, but they're going to kill the economy at the same time, and that's
right.
another way to get inflation under control.
Right. And I kind of, you can kind of think about it like if you want to get inflation under control, there's two ways you can effectively do it, right? You can dramatically increase the supply of things, right? That would normally bring down prices if you increase supply, right? Or you can crush demand, right? So it's kind of like Econ 101. It appears, absence of an abundance of housing showing up or whatever, that it's not going to be supply that's going to be increased, it's going to be demand that's going to be crushed. That's what we appear to be looking at. It's not like oil is going to be produced in mass quantities all of a sudden coming out of the ground in the Permian Basin to help lower oil prices. Like that's not happening, right? It's demand that they're trying to solve the supply demand imbalance with.
Yeah. No, this is great. And I think I want to now shift to, now that we have a good sense and good idea of kind of what we've seen in Q3 and what's led up to what we are seeing, like the why behind what we're seeing in Q3. And you highlighted something really important, Matt Kolesky, that a lot of what we're seeing manifest in the world today is not just from what happened with COVID-19. And I think that's what a lot of people are realizing, deeper down, is that this is stemming from 10 to 15 years of QE and propping up of assets through the inflection of credit and money supply. And that's this. I mean, again, you can't go through that many years and that long. And we've had this historical bull market run. And I just remember when I was sitting in the seat back and advising clients back in 2017, 2018. Even then, everyone, there were still rumblings of, okay, we can't keep this up forever. And then obviously we've gone through. So I think that provides a good context now, I guess, to start diving into kind of digital asset markets and how the traditional markets maybe are affecting still on the digital side. So I'd love to get to you, Matt Kolesky. Did we see a continuation, what we saw in Q3 this year, as we've seen in the first two quarters, or what's going on?
Yeah, Q3, you mentioned earlier, Mark, right? There's a little bit of a rebound, and then, things just continue to fall off. And so there's a couple things there. This idea of correlation between the traditional and the digital markets that has kind of ramped up. And again, this goes generally like when things are getting tough, correlations go towards one and everybody just wants to sell, right? And digital assets are literally some of the most liquid assets. They trade 24/7. You can sell them in Singapore at noon on a Saturday, Sunday, whatever day it is, whatever you are in the world, you can sell, right? Which is very different from the traditional markets. But I think one of the other things in terms of getting beyond a little bit about the performance is, I think when we think of adoption, Mark, and you highlighted this in our newsletter, like all of the traditional firms that are now, starting to come into this place after years of either non-acceptance or outright hostility. I'll be honest, right? That's what I've seen over the last 5 years. Now the firms are saying, wait a second, there's something here. This is just technology. It's not, and there are plenty of people in the universe that get into, bad things and scammers and rug pulls and all that stuff, but there's a really value here. And so I think you're starting to see for the first time, these traditional institutions starting to really wake up and take this seriously and investing time and energy, not just to understand it, but to develop platforms to support it. And so one of my biggest takeaways really over Q3 and even from the last year is how is crypto and these, blockchain protocols going to interact and intersect with the traditional world? And I think we're starting to see that play out. And so one of the things I'll say is, which this might agitate some of the pure crypto people that are, not your keys, not your crypto. I never felt like the vast majority of people were going to go that way, because that's not how humans work. They want things easy and they want things simple. I always say people like going to Disneyland. I like going to McDonald's. They know what they're getting, right? They know what they don't have to think about it. Like, and So as we see this pivot from this pure crypto play to like, how does crypto and the traditional world intersect? We're starting to see those bridges get built and actually infrastructure play out. And I think that's one of the biggest developments from not just Q3, but from 2022. And Mark, looking at, like I said, the newsletter, I mean, literally there's like, what, 20 companies? I think every major firm, with the exception of Vanguard, right? But everybody else is building or doing something in crypto. And so when we think about adoption, right, of these networks, that's a different type of adoption, right? We've been tracking wallets and active addresses and, on-chain metrics and things like that, which is still incredibly important. But now we've got this other thing to be mindful of, is how are traditional firms and how are traditional infrastructure companies getting into the space and starting to adopt from that level.
The other thing I'd like to layer onto that, though, and this kind of merges thought process in terms of the digital world and the traditional world, especially when we're looking at within Arbor Capital, right? We make a maybe 3 speculative investments within our portfolio as well, right? And so I think about it in terms of like, well, what business problem are we actually trying to solve, right? So it could be within Arbor Digital land, it could be within traditional, but that fundamental question of what business problem you're trying to solve is really paramount, because that's probably why you're investing in that security token or that company in the first place, right? Especially when they're in, very much of a startup type organization. And so I think to even this, just distill it, we're both looking at it from that, from that lens.
Yeah,
we may verbalize it differently, but I think we're looking at it the same way.
You're exactly right, Matt, and that's one of our points when we're doing the analysis and research on these protocols. Like, what problem is this trying to solve, and is there a legitimate use case for blockchain technology in this, or is it just something, putting a shiny coat of paint on something that's been done before? And I always go back to, at the end of the day, it is technology, and we all know what technology does, and it's pretty relentless in its drive for value and efficiency, regardless of what the regulators think. I always look, not making a judgment on Uber, but I just think of how they were approaching different markets around the world that had these, well, there's only, 5,000 cab permits, and that's of course all there ever can be. It's like, no, here comes technology that's just going to completely demolish that type of thinking and use technology and networks and everything that we have on our phones to create new connections and new economies.
Well, I think also what gets lost in this space, and kind of where Arbor Digital is purely focused on, is that you've got the technology underpinning, and then you now have the new types of software and software experiences you can build on top of that new technology. Now, that's obviously a much more speculative place to go live in, because it's so experimental. And that's where we've seen a lot of things happening in the markets this year, specifically in digital assets, where you've seen these experiments just go completely wrong. But the idea of what problems they were trying to solve, and again, if you think back to where Bitcoin, and again, Matt, you have way more ties to the history of Bitcoin and engaging with it, but it really just started as a method of transferring value in a disintermediated way, and then the way that it was accounted for was on a distributed public ledger.
Correct. And I think, listening, my comments earlier about money and it's this unit of account, right? And so when the Fed is, they can fill the pool and drain the pool, it's like, okay, what are they doing here? And why are we trusting them to do this? That's really what got me excited about Bitcoin. It's like, here's a standard. It's all laid out. You can't play political games with it. And that's what gives it a lot of power. And it also is a threat to obviously a lot of the traditional power incumbent institutions. But that's, kind of putting this together, at Arbor, we approached Bitcoin digital assets through the alternative lens. And Matt, we didn't really talk about it, but that's one of the things that's done well, not the digital asset piece, but we have other alternatives in our portfolios that have done really well this year. And this is a reason, anyway, the point being is this type of thinking of like, not just 60-40, not just cookie cutter stuff, right? We're actually going to create portfolios that are robust and can withstand some of the downturns that we're seeing here. And that's what's led us to digital assets.
Yeah, so I guess to recap, it sounds like although digital assets from a broader standpoint are still following this narrative tied to risky assets, where when we see these broad sell-offs. However, what I think needs to be mentioned is that specifically in Q3, what we saw was Bitcoin pretty much followed that, but where you saw things start to deviate within digital assets was going into the different sectors and what's being built on top of this technology now. So what we saw from our portfolios is that while Bitcoin and especially even Ethereum from a quarter standpoint completely outperformed everything else, is up 25% in the quarter. And then along with the other further down the spectrum assets, those recovered better. And when I say those, it's the ones that are solving the real problems and who have been always trying to solve the real problems that they could come in over the last 3 to 4 years. Those are the ones that are outstanding relative to every other protocols that come in and say, oh, we've got this new thing that can do it even better than this first incumbent. So one of the things we're looking at, so Schechter, I'm going to try to do a little bit of comparison here. We've been looking at the borrowing lending markets within decentralized finance and some of the top protocols. We've been looking at some of the exchange volumes because we're trying to really get to this adoption. Are we actually getting adoption? And if so, are these organizations, and I'll call them organizations, I'm not going to call them companies, but they are this new way of being formed as an organization. What we are seeing is, although growth has stagnated in terms of wallets and users, loan originations, smart contracts to which everything is built upon have actually still been increasing. So the adoption rate of actually using the technology has been increasing. And what we attribute that to is, sure, it may have been driven by retail in DeFi summer of 2020, but what we're starting to see now, Kolesky, to go back to what you said, is we're seeing this merge happen. And if you follow me on LinkedIn or any of my socials, you'll see I talk about the merge, and it's the merge of the traditional world with this, crypto, digital asset, Web3 economy.
Not the Ethereum merge, which did happen in Q3 also.
Yes, which was also a very, very important piece. But so I think one of the things that's really shaped Q3 in digital asset markets and the traditional world was just so many. Matt, you mentioned you had BNY Mellon coming and launching custody for traditional players. I mean, that is massive announcements. And then if you go even just past, that's just finance. You saw so many traditional companies in the finance sector of traditional world just announcing all of these partnerships and plans and investments into the space. And I think it's really important to highlight, they're not investing in their own private ones. It's all about integrating with the Ethereum blockchain or other players like Avalanche. It's not that they're going building their own, even though that is an option. So I think that's a really important piece that I think settled off. And then you go and look at just from a general population standpoint of adoption. How is crypto going to engage with the general population without them even knowing it? And part of that we saw was Starbucks launching their experience now, their rewards experience now will, on the back end, will start experimenting with distributed, decentralized blockchains. They didn't go to JP Morgan and say, we're going to go on Onyx to go experiment with our rewards program. They're going in this distributed place where they're going to start experimenting with NFTs and all of that good stuff. So this traditional merging and melding, I think, is something that we've been swinging, and we've been saying that the institutions are coming and all of these things are going to happen. Now we're starting to see the actual fruits of that labor and all those conversations that probably had. Now you're starting to see actual action from there. But Schechter, I'd like to turn this to you in your world and what you're seeing. And you're on these earnings calls, and you mentioned Microsoft, you mentioned McDonald's, you mentioned these other things. Are digital assets, is crypto, Web3, are any of these things coming up on those earnings calls?
On occasion, you'll hear about crypto. It kind of depends on the company. It's I wouldn't say it's forefront in everybody's mind. On the banks, you might get an occasional question. We owned PayPal once a while back, and they would bring up the issue. It's not. The way I would phrase it is not being integrated into their business processes, either as something readily apparent in the form of utilizing cryptocurrencies or using blockchain on the back end. So that to me is, I oftentimes think it's not the crypto that's the currencies or whatever it's most interesting. It's the blockchain technology behind it. And how does that get integrated into business practices? And who's going to be the beneficiary of that? So you mentioned smart contracts, right? To the extent that companies start talking about utilizing smart contracts in their business processes, that would probably grab my attention personally a lot more than a company deciding that they were going to use Bitcoin as a method of transaction, right? So that's that, but that's just me personally. And you're not really hearing, that type of merge. I mean, obviously you have the banks that are kind of looking at these currencies in America. You have MasterCard and Visa. I guess in the payment processes space, MasterCard, Visa, they do talk about being able to move the currencies over their rails and kind of, integrating the two worlds. So that's probably the one area where I'd say we hear about it the most is in payment space. Hopefully that answers the question.
No, it does. And I think one of the most interesting I think two things come out from that. What I think of when you say that, I think slow your horses, slow your roll a little bit, everybody. Yes, we've got all these announcements, but again, we're not going to start to see that manifest from an adoption or a price standpoint as quickly as you may think. Again, I think it's an important thing to come about. And then I think you mentioned also building smart contracts or the blockchains into business processes. And yeah, the way we think about it is the blockchain and the technology underneath it, what we're seeing it evolve into is, yes, this is a way to bring together people to work towards a common goal and solve a common problem. It's just a new way of organizing within these, DAOs, and utilizing the technology, and the fact that it makes it distributed has all these benefits to, governance, to security. And again, does everything need to be in a decentralized, distributed public network? No. And I think that's where we're going to see where that fits in the traditional world. But I think even one of the more exciting things I got when I saw this quarter was, E&Y, when they announced that they were building an Ethereum-based product, a service so using the Ethereum blockchain, a service that was going to be kind of an ESG approved operations chain to work with the flow of operations. And I thought that was just really interesting.
Right. If you think of any industry which has a tremendous amount of paperwork and the movement of product across borders, or just the movement of effectively an immovable product like a house, think about basically buying and selling a house using smart chain contracts, real estate, right, agriculture, shipping, commodities, the movement of commodities. To the extent that there are problems out there in terms of tracking and all that type of stuff, and there are problems that can be solved being blockchain, that to me is what gets me excited about the Arbor Digital and the technology. Maybe I'm just more of an operations wonk in terms of this type of stuff.
No, but you're spot on, Matt. It's how can we make these systems more efficient? That's all technology is, and blockchain can enable that. And I'm not going to geek out too much on some of the technicals, but Mark, one of the other things that I've noticed a lot in the last quarter, even in 2022, is the idea of, and we've seen this with Ethereum and with Optimism and some of these idea of proofs and ZK, either roll-ups or zero knowledge proofs, which is another very unique piece of technology. And what that means is if Matt Schechter knows something and has something, and I just need to verify that he has it, or I need to verify some characteristic of that he has, the technology and the code can do that without having him to reveal the whole nature of what he's trying to reveal. And that's really powerful from an auditing perspective, even from a regulatory perspective. If you come in and say, I need to audit this, and this, you can say, well, great. Here's all this stuff. I put it in the smart contract. You can see what you need to see, and you don't need to see anything else. Like, that is really powerful. And there's things getting built, a lot of this even on the Ethereum network, with some of the different, ways that this can get done. And it's pretty powerful. And we're still in the very early stages of this, but that's what gets me excited still.
Yeah, and just to kind of segue a little bit, I mean, on the traditional side, like when I think about new technologies, which actually getting me more excited is kind of like on the product side of things, not on the software side of things. Yeah, maybe that'll change in 6 months or a year's time. But when I think about like what gets me excited about speculative stuff in the future from the traditional side, it's more hardware, not software, which sounds kind of, because everybody talks about software, it seems like, but
software is eating the world, right?
You would think that, but from a traditional side, paying 40 times revenues for it is not the right thing to do.
I think there was, Matt, maybe I'm reading too much into this, but I think there was an overinvestment in SaaS companies, for all kinds of different things, because that was, they were all unicorns, and so there's been a lot of VC money that's gone into that in the last 5 years.
Yeah, and we generally haven't invested too much in SaaS, and when we do, I'm generally not happy with the results. So I tend to avoid most software companies, whether we're talking about the growth book we have or the value book we have.
Well, so I guess to round this out, to give everyone a quick state of the union on Q3 and how it ended up. I mean, again, I think Q3 in digital asset land is going to be more. It's going to be remembered for two things. First, it's going to be the Ethereum merge. The fact that went the way it did, and again, not to fanfare, not to all of this crazy grandstanding to see how great we are. It was just pretty quiet, and it just went through. And again, to say that there was nothing wrong, I think would be a mischaracterization. There were some small bugs, there were some validators, there were some nodes that did go down. It was a very small percentage, but overall, again, if you're talking about releasing a complete network upgrade, think about moving a big ship that is the Microsoft or the Google. You kind of wish and you hope that things go that well. So, and I think that will go down. Merge day is definitely going to be a holiday, I think, moving forward. And I think the second thing that really is what shaped Q3 is really just the melding in the traditional and the crypto economy. You're just starting to see more of the bigger names in the traditional world, taking more action. So I guess from the investment side, we did see a little bit of a decoupling from a correlation standpoint. Matt, you mentioned the correlation story. I think it's important to go through that. Bitcoin does continue to trade like a risky, small tech stock asset. It's still following, still highly correlated. But we did see Ethereum and these other projects and networks start to decouple from that, where they had a much lower correlation. And I think just to round that out, historically, Bitcoin and Ethereum have been pretty close in correlation to the S&P, the Russell 2000, or the NASDAQ, to where it's probably within a range of 0 to 0.15. Now what we're seeing, it has increased given where we've gone with tightening. This is the first time these markets have gone through this type of economic cycle, to where the Fed's doing what they're doing. We're going through this tightening. We're going through a bear market. So correlations have risen. The ranges now historically, looking back to inception of both Ethereum and Bitcoin, are in the ranges of 0.35 and 0.44. So again, that's a huge increase, and to ignore it, I think, would be a mistake. So while there is still a lot of good correlation benefits to have, it's still important to pay attention that they are rising, and it'll be interesting to see as we go through the different or the cycle, how that continues to play out. And so now I'd like to kind of go into the regulatory landscape and finish this conversation around just the state of markets, and then we can finish off with kind of what we're looking for to end off the year and beyond. Man, from a price standpoint, we may be in crypto winter. No, we are in crypto winter, but from a regulatory and from an adoption standpoint, man, it seems like we're in crypto spring. So Matt, give us a quick rundown. What are you seeing on the regulatory side?
I'm assuming you mean Kolesky.
Sorry, Kolesky. I got to get used to having two Matts on the call.
Okay.
I have it here. Mark, we talked about this. Like, this is the crypto asset. It's not going to show up. Implications for consumers and investors from the Department of Treasury. All 40 or 50 pages of that. So I did go through there. I said earlier, and I'll get into the answer to the question here in a second, Mark, but I said, technology tends to keep pushing forward despite regulation. And so I think what we've seen is two thoughts here, a little bit of a hesitancy from the regulatory bodies to fully engage, which doesn't necessarily mean a bad thing. It does allow some of the innovation to take place, but it does raise the specter of who's in charge here. Is it the SEC or the CFTC? Those are kind of the two main regulatory bodies that are going to be duking this out, it feels like. But Mark, I think what prompted the question too is, we've got, this all stems from that Biden executive order earlier in this year that asked these regulatory bodies, as well as other parts of the government, the Department of the Treasury, and literally like every single department in the government to have an answer for digital assets. Like, how are they going to either use these or approach them, or at least start thinking about them? And Matt, you talked about this even with companies, like not necessarily seeing it yet, but it's there, and they're going to start thinking about how to become more efficient. So my general thoughts on this particular piece was it was written by folks that are still, not fully embracing the digital assets. And again, this is particularly from the U.S. Treasury. So I thought that was interesting. There is a recognition that, yes, we need to create settlement networks that are faster and more efficient than what we currently have. There's a recognition that we need SWIFT is I don't want to say obsolete because it's still being used, but relative to what blockchain technology can enable, it kind of is. But that's going to take a regulatory push to get there. Specific to the SEC, Gensler sticking to his guns about the Howey test, which is 70 years old, and doesn't take into consideration the fact that there could be a path towards decentralization. Maybe it starts as a security, but in 2 or 3 years, it's not. It no longer relies on those 4 prongs. It's a very different economic and business structure than a traditional corporation. And there's nothing wrong with traditional corporations, but this is a very different. Mark, you mentioned it earlier. I'm not going to call them organizations or businesses, because they're very different. These are a very different structure, and we haven't yet seen clarity about that. And that's what's, I think, is somewhat a little bit disappointing for those of us that have been in the industry for such a long time. Regulators are sticking to their guns. Gensler's like, if it walks like a duck and quacks like a duck, it probably is. Well, it's not necessarily a duck. This is technology, and they're running on networks, and it's very different. And I'm hopeful that we'll get there.
It's walking like a duck, but then you hear a ribbit sound out of it. And
exactly.
Well, I kind of view it a little bit more simplistically, and it kind of goes back to, regardless of the organizational structure, right? It kind of goes back to, it's just, you have a security that you're trading. And so from my perspective and an investment perspective, I'm looking at it from, I'm going to wake up one morning and I don't know when that's going to be. It could be a long time from now. And a lot of these NFTs and all these security tokens are going to be officially declared securities and required to come under regulatory authority. Right. And then the world changes.
It's a very good point, Matt. And one of the things that I find very fascinating about that is, Bitcoin, the way it was launched, and we don't even know who the owner or the original pseudonym is, Satoshi Nakamoto's. But Ethereum, a lot of the regulators say, well, Ethereum is not a security. But if you look at how it was launched, it kind of fits with it went through this process, and now it's sufficiently decentralized. But they're already saying that that's okay. That's where I don't get that's where some of the confusion comes in, where it's like, okay, you're kind of saying Ethereum is not a security, but a lot of these other tokens went through the same process, and now you're going to call them a security just because they did it in the last 3 years and not 8 years ago or whatever. That's where I think they're going to run into some trouble of saying, if this is a security, this isn't. And that's why there's nothing wrong with the Howey test, but it does I think it needs to be updated and modernized for these 2 new types of organizational structures. If you look at the 4 prongs, I'm not going to get into all 4 of them, but I've spent lots of time thinking about it and how they relate to this. You can make cases on either side, especially for some of these, how these were launched, about why they're not a security.
Yeah,
right, and I go back to these. I think about it intellectually like it's any other asset. If my goal is to buy it at 10 and sell it at 20, it's an investment. So. If that's my end goal is to buy low and sell high, like I don't see why it's any different than buying a share of Pepsi. Like, that's
a bottle of wine. Is a bottle of wine or a piece of art? Is that a security?
It gets traded. The difference is that a piece of art doesn't get traded. Trades once every 20 years when it goes through Sotheby's, right? The difference here is that there's just a lot more liquidity in what you're seeing in a security relative to a bottle of wine. That's,
and that's where, again, I think regulators haven't had to deal with what this new technology can do. And so this is something we talk about: tokenization, fractionalization of assets, I think is a huge, would that piece of art only getting traded on Sotheby's once every 20 years? Would it have traded that like that if there was a decentralized public, if it could live and be fractionalized and tokenized? But now
Well,
you can see the creation of these secondary markets.
Right. Well, if I put my accounting hat on, the only difference is how do you value it? Because technically, if you have a piece of art, that's a level 3 asset.
Yep.
Right. If I have a publicly traded security, that's a level 1 asset.
Yeah, and I think
the only major difference is the open liquidity of, if that same piece of art that was a level 3 could trade every day, it'd be a level 1 because you'd have a readily identifiable price. Right?
Yeah, and I think what people get lost in is that it's a bad thing for these things to end up, being deemed as a security, and I don't think that's what anybody is thinking, or at least we don't. Like, it's okay, but again, and this is kind of what happened in Q3, and I think what we saw from a regulatory standpoint too was two things. One is that we still see the CFTC and the SEC, kind of, regulating by enforcement, right? The whole tornado cash thing that happened, really raises a ton of questions. Can you enforce sanctions on a technology? And that's going to open up a huge can of worms, right? So that's a big deal. So, and I think that's where we struggle a little bit when we hear these things and we say, well, you can't do that. You can't sanction a technology. You can't sanction a piece of the tech stack. Like, why aren't you sanctioning the actual people and the actual, actors who are driving the behaviors behind that? And that's where it's a little frustrating. So that's kind of, what we're still seeing from a regulatory front. But I think where it's shifted a little bit is with the release of the reports. I think you're starting to see, again, from a global aspect too, and I think we wrote about this in one of the weekly updates, is we do, obviously, since we service the US markets, we do have more of a home bias when we talk about regulatory landscape and all that, and that's fine. But I think it is important to highlight that these assets are truly global. There are different regulatory bodies from the European Union to the UK to African nations, you name it. They're all creating their own regulatory frameworks around this and the same assets. So the same assets we all hold in the US, it's the same. They're all the same across the world. And so what is exciting is you're starting to see, again, more action. It's more of like springtime, like more of the regulatory clarity. You got MICA in Europe over, finally the regulators agreeing on a framework to where they can go and then start implementing. I think that's a huge step forward. And then you're going to start to see all these different nations on a global scale start to pick and choose. Like, okay, we kind of like what they did over here, kind of don't like what they did over here. Okay, how can we now incorporate this into our regulatory framework? So it was exciting. It's hard not to be in a positive view, a little bit bullish from a regulatory standpoint, considering how much further things have been going, even with the enforcement actions we're seeing in Q3.
Yeah, Mark, and I'm glad you mentioned the global aspect of it. You talked about the MICA and what's going on in Europe, right? And you're right. And this is where it's hard for the SEC and the CFTC because they're bound by the borders of the United States, right? That's it. That's their jurisdictional. It ends there. But these are global networks, and it creates a totally different challenge for them, and to be able to regulate that from just the focus of within the borders of the United States. So I am hopeful. I would love to see some cross-regulatory, international cooperation to get this done, because at the end of the day, that's what the internet is. It's an international network. Yeah. Right. And so that would be amazing to see. But yeah, it's good to see that there's regulators, not just in the US, but around the world, that are moving forward and embracing it and acknowledging that, hey, this is innovation. We don't want to kill it. We want to let it mature to some degree without providing a lot, without creating a lot of damage to folks that at the end of the economic spectrum, which happens already because of anyway.
Well, and I think one thing that I don't think is getting enough airtime, quote lines, whatever you name it, is the proof of concept blockchain that Swift is now building and then utilizing Chainlink. So there's going to be both an on and off chain element to that proof of concept. It won't just be some sort of private blockchain for the settlement. And so when you start to see because you mentioned Swift earlier and how the system needs to be upgraded and all that, that's really interesting. And if you weren't in the space and you just read everything that was normal, you would never have even heard about it. You wouldn't even know that that's a thing until 8 months from now, when Swift announces that they now are operating both on and off chain to start enabling payments between certain kind of just how in the US, how in their CBDC, I can see it and envision how it may play out similarly to how like in Massachusetts and MIT and how they were doing the CBDC project and how they were experimenting on blockchains with payments and sending value across the internet. You're going to see something similar there. And I think that's something that nobody's talking about, which is really interesting just in itself.
The last thing I'll say to that, Mark, it's, these protocols, and we were talking earlier about like value, like what problem is this solving? And that's a perfect example, right? There's this legacy infrastructure that's been around for 60 years, integrating and experimenting with blockchain protocols that have been around a while. Mark, you and I talked about this, like what are these battle tested protocols that have been through not just one or two crypto winters, but they just continue to build, and they continue to just head down, build the protocol. That's where the real value is going to come home. And then you see these traditional institutions, whether it's Swift or even a bank, starting to interact. Okay, these guys have been around for 4 or 5, 6 years. Their protocols are tested. We want to work with them. That's what's exciting.
And then when you see, so everyone knows the name Google, Alphabet, everyone kind of would look to them and say, yeah, they were pioneers of the age of the internet, right? And I think when you get some of the people who were there at the beginning, before they were there and they built that, those people are now who are very late in their careers, later in their lives, and they're saying that this is similar and that there are actually new and this can be upgraded. You got to pay attention to that. So I think we saw a lot of that in Q3. So what I'd like to end off now with Schechter, I'd love to start with you on this. Is what are you looking at now? Because you mentioned earnings and a bunch of these things that you looked at for Q2 into Q3. How is that looking for heading into Q4, and what are we thinking beyond that as well?
Okay, well, from a fundamental or economic perspective, I don't think I'm probably alone in saying I don't have a rosy outlook on where I think the economy is going at this point in time. I think from a macro perspective, I think the Fed is will continue to raise interest rates effectively until something breaks. And what breaks, I don't know what it is. Is it something in real estate? Is it in the bond markets? Right? You had a surprise with the UK gilt, as a result of some actions that the new UK government wanted to take, and there was, a small meltdown, but small meltdown nonetheless. So I'm kind of watching over the next 3 to 12 months for what breaks. I think what people need to keep in mind is that cycles like this sometimes take a couple of years to play out.
Yep.
And they don't play out in a straight line, and you have bear market rallies. And so from an equity market perspective, and even from a bond market's perspective, I don't necessarily kind of see the light at the end of the tunnel yet. But what I think is interesting, and this is from a macro perspective and how it kind of shapes what I'm looking at from an equity perspective, it may even dovetail a little bit into some of the discussion we had on digital, is I think we are seeing the start of a bifurcation of things like commodities and the utilization of them, technology, and I think we're going to see that accelerate. I think, unfortunately, the war in Ukraine kind of brought that to the forefront for things like oil and natural gas and various commodities surrounding that. I think you were talking earlier about using blockchain and Swift. It's my personal opinion that the Chinese would like nothing better to do than to get off the Swift financial system and do their own thing. And I think there are a number of other governments, Russia and others, that would be more than willing to go with them, right? So those types of events, I'm kind of watching closely as I think they slowly, kind of unfold. These won't take place in a matter of weeks. It may take place in a matter of years, but it appears to be occurring. So those types of events are kind of on my radar screen from a very much a global kind of perspective. Looking at Europe, we're kind of heading into winter, right? And so, the energy market in Europe, I think, has been changed, with the war, but especially when the sabotage of the Nord Stream 2 came out, I think that was a big event, and I think Europe basically has to rethink its energy policy. And the ramifications of that are just enormous. If they're not getting their energy from Russia, where are they going to get it from? They can get it from the United States. Are they going to, do nuclear? How does that impact inflation in in their country and manufacturing. I mean, it's a huge issue. So I think sometimes we think just kind of in the US that what's going on in Europe is actually worse, right? And so I think people need to, that are listening to this podcast need to be aware of that. And so from a Europe, from a kind of more of a short-term perspective, that's something that's definitely kind of on my radar. I think that the most recent rules that the Biden administration put forth towards China in terms of limiting, basically banning the manufacturing equipment that could go into the semiconductor industry, I think is probably broad enough where it'll affect other industries within China. We already 3 years ago or whatever it was, we already basically banned Huawei. If I was a US company doing business in China, heavily reliant on either China supply chain or sales out of China, I would be more nervous this week than I was 2 weeks ago. And that could be the largest companies to Tesla and Apple to consumer companies. It's a little bit, I think we're moving in, to slightly more dangerous waters when it comes to dealing with China in that perspective. And I want to see geopolitically what happens.
Yeah.
So those are just like, a few things internationally. In the US, I'm really kind of focused on what's going on with real estate and the mortgage markets.
Yeah.
In terms of issues. I've been, credit quality looks fine right now. But real estate prices shot through the ceiling at a very cheap cost of capital. So now you have a situation where real estate prices are sinking. And yeah, congratulations, you have a 3% mortgage for 30 years. You're not going to be able to sell your house and get any equity out of it because you're effectively the market value of it. It's just declined 40% because the next person to buy that house needs to use a 7 or 8% mortgage. What's the ramifications of that? And I'm even thinking further than that in terms of like people that own second houses, even, for recreational or that are doing short-term leasing or Airbnb. If there was leverage that was used to effectively buy real estate, right? You hear from the right people, like leverage kills, right? And so I'm thinking like, where is there continued leverage in the system where there's problems? Could be in crypto, could be in US real estate, it could be with hedge funds, right? So, where is leverage sitting out there where maybe the ramifications of it haven't become totally clear, right? And that's just a replay of the subprime financial, of the financial crisis. I'll kind of give this example for people on the podcast. When I was at CFRA, right, everybody thinks about the financial crisis as being like 2008 to 2009, right? Kind of in that period, right? But a lot of the housing problems with subprime and option arms, and a lot of those companies started blowing up, circa 2006, early 2007. So, it was kind of like you kind of watch, the subprime and kind of the lower credit quality, problems manifest. And then you kind of went up the credit spectrum. And that's what I'm kind of watching for closely now is like, well, how far up the credit spectrum do problems go? And then, we've had things like securitized receivables. People remember from the financial crisis that, companies were holding these collateralized mortgage obligations, the CLOs, right? And CDOs, right? And so, there was a lot of securitization that went on the last few years with all different types of receivables, whether you were Carvana or whether you were a firm. So where are those receivables sitting on institutions' balance sheets, right? I don't know whether it's a big issue or a small issue. Those are the things I'm thinking about over time.
Yeah.
Right? So, a little bit less digital, but more than traditional.
No, that's exactly what we were, love to get the perspective. Because again, although this Arbor Digital is living and breathing in the digital asset crypto space, it is important because I think one of the learnings from Q3 and I think overall in this year is that sure, this is a new and emerging asset class, but it still exists within the same world that everything else exists within. And so there are going to be ramifications that you are going to see things manifest in these markets, just like how they manifest in traditional markets. So if you don't have an understanding or aren't paying attention to the bigger things happening in traditional markets, like a lot of the things you just mentioned, you'd be losing in. I think that's the value specifically of Arbor Digital, and why our team is the ones that are primed to help people, and not just with the digital side. And we have Arbor Capital, who are helping our traditional investors navigate through these types of markets, not just today, but also when things are good. It's important that we're always thinking about these things. And so I'd like to end this off. While things may seem doom and gloom, and things aren't looking great, this is the time to where actually we are working as hard as ever to make sure we are guiding people through these waters, both on the digital side and the traditional side. So I guess, Matt, if you had to talk to the audience here about what you should be doing in terms of action, what should investors be doing, both on the traditional and the digital side?
So I think.
Oh, sorry, Kolesky. Sorry.
Say, which Matt, Mark? I always, I've been in this business, since 2000, 2001, and I've always thought that, the markets can manifest in different ways, and things have changed over the last 20 years, and I'm not going to get into that, but people tend to be too bullish at the top and too bearish at the bottom. And it's a feeling. When I can remember Matt, you were talking about the financial crisis, when the markets were just free falling every day, down 4, 5, 8, 9%. It's like every day, and what that felt like. And nobody wants to buy or do anything then. Now, we're clearly not there in terms of a volatility perspective, but I'm going to give the boring answer, Mark. It's about why we have diversification and disciplined portfolio construction, right? That's really what it comes down to. Our portfolio is up on the year, no, but we are significantly better off than even most bond portfolios across a lot of our clients. Not on the digital side, clearly, and so it's just taking assessment of your allocation, making sure you understand where the risks are, and if you're ready, deploying capital. And what we're seeing, Matt Schechter, right, is, I don't have to say Matt Schechter because I'm the other Matt. We're seeing people, right, where we can finally get yield now with, you've created this preferred portfolio. We're getting CD rates north, and treasury rates on the short term north of 4.5%. So it's shifting this mindset. That's one of the things that has happened, Mark. I've talked about this diversified approach, which is always good, but we haven't been able to get yield for 10 years. And now we're actually finally able to get it. And that does shift how we're allocating. And that's a big thing. How much cash do you have at the bank? How much are you sitting on? Like, that needs to not be sitting there, and you can actually earn some yield on it now.
Yeah, and I would actually say with the environment, even though there were problems, I tell clients, I'd be like, sometimes I can best play offense when I know we have a really good defense.
Right.
Right. And now you have CD rates at points to a year ago, you really couldn't play defense. Right. Now you can, and that doesn't mean you're incredibly aggressive, but it does mean that if you own speculative assets, right, and the businesses are performing as you expect, right, then it's a question of riding out the volatility, and hopefully the businesses manifest into what you actually think are, going to be great businesses in the future, whether it's on the digital side or the traditional side. I guess I'm actually I'm actually least bullish on companies as it relates to valuation with that have higher valuations now, because they can get cheaper, right? But when it comes to areas like speculative businesses that are growing, or energy, or CDs, like, I think it's a good environment. And that wasn't the case 12 months ago.
Yeah.
So, and it may not be the case looking forward 12 months from now.
Yeah.
We'll just, it's, from a traditional perspective, it's like, okay, what's the latest batch of data? What are the companies telling me? What do I hear from the macro side? And then what are the companies telling me how they're doing with their businesses, right? And then thinking about that in light of, what's going on with pricing in the markets. And digital valuation's hard, right? But I have a schedule for Arbor Traditional where I can say, okay, here's their current valuation. Here was their valuation pre-COVID, right? If their earnings get cut by 10%, how much more downside there is, right? Should I buy, hold, or sell, right? And so, that type of, having that is important on the traditional side, hard to do on the digital side.
Yeah, although hard on the digital side, we can apply some of the things we've learned from traditional side to help us navigate, which we do, and I would say that's the benefit. And it's where, if from a digital asset perspective, and if you're looking to allocate to this space, I think one of the important things is to look at those. And if you don't have a process, I think what we're realizing, and what I think people are realizing too, is that there are people who are investing in this space that do have a process, like us. And there are others in the space who are also responsibly investing. It's not just us. But I think what I would end this off with, what we should be thinking about, if you are thinking about engaging with digital assets or putting capital to work in this space, is working with partners and working with advisors who have a process to how they're deploying. One of the things that I say we've helped our clients do, because they're still some are just very excited and they don't care what's going on in the world, and they're just like, nope, I got to get in, this is the lowest I've ever gotten in. And we can help curb those emotions. So when you see a bear market rally, like we've seen a couple times, especially in Q3, where people get really excited, like, all right, I'm ready to throw in at 25K, 26K Bitcoin price, or when Ethereum's at 2,000, we can come in with a disciplined approach and say, hey, well, this is what we see, and this is where we would deploy, and it's not quite here. So what we've done is we've helped people really formulate a process and have that process. And again, to do that in this space, in the digital space, it's a 24/7 space. It's 365. The thing could be happening there, and that's where, again, having a trusted partner to do that. So
and it's a less liquid, more volatile market.
Exactly.
I mean, you just don't have the liquidity with a lot of the investments. It happens.
Mm-hmm. Yeah. So we've gone on. This has been such a great conversation. I love that we got to get to go both digital and traditional. It's so important. Matt Schechter, thank you so much for coming on today. It was a pleasure having you.
You're great being on. Look forward to doing it again.
Yeah, great. And Matt Kolesky, thank you again, as always. You were actually one of the most recent podcast episode for Mount Gott, so we've got some good feedback from that one so far.
Awesome. Well, yeah, thanks, Schechter. Good to have you on, and Mark, always a pleasure.
Great. And y'all, thank you everyone for listening to this edition of the Asset Revolution podcast. Be sure to check us out both on the traditional side at arborcapital.io. We'll put a link down in the notes. And then for any digital asset needs you may have, please reach out to us via our website at arbordigital.io. And until next time, be sure to tell somebody today that you care about them, and we'll see you then. Cheers, everybody. We appreciate you listening to this edition of the Asset Revolution podcast. I'm your host, Marc Nichols. Please don't forget to let us know how you like the show by rating and reviewing us on Apple Podcasts or wherever you like to listen. For more downloadable digital asset resources and educational opportunities, please visit us at arbordigital.io. We are here to help you get off zero safely and securely. Thanks again for tuning in, and be sure to tell someone you care about them. Cheers.
Financial advisor, unless you're under contract with or actively speaking with Arbor Capital Management or Arbor Digital, a division of Arbor Capital Management. This podcast is just that, a podcast. It is not financial, legal, or tax advice. If you have individual questions, please reach out.